What explains it? What explains the relentless grind lower in Vol's cross-asset?
Yeah, so the price of an option is really based on a replicating strategy, and that strategy is in trading the underlying asset, the delta hedging back and forth.
Yeah.
When the underlying doesn't move, the option's worth less because the delta hedging strategy makes less money. So let's put the VIX, the 10 VIX in context. The realized volatility in the S&P over the last 10 days, the last 2 weeks, is 3%. Over the last 6 months, it's at 6.7. You have to not just go back to the pre-financial crisis period, you have to go well through it. It's a 25-year low in 6-month realized volatility. So then the question is, well, what's making realized volatility so low? And I would just point to flows. So Bill Gross once called share buybacks, he called it corporate QE.
Right.
I would call the new corporate QE Jack Bogle's Vanguard fund. He's getting stuffed with $1 billion a day. And the money just has to be put to use. He's not timing the market. He's not doing any research. That's indexation. It just buys in a price agnostic fashion. The flows are dominating everything.
Are we blaming Vanguard for low VIX, John?
I'm the wrong guy to ask about that. I agree. I think there are a lot of things going on. I mean, first of all, the tremendous disconnect between, let's say, a very volatile Washington and a very non-volatile New York, which makes me wonder how much it really does matter what goes on there. I know it does in my own life and our lives. But for the stock market, we're in a situation where the flows are good. The Fed is still pretty accommodative. They're going to raise rates, but only if they don't adversely affect the economy. The earnings are getting better, and the valuation is sort of at the low end of high. It's not outrageous. It's not high enough to bring it down by itself. It's not a bad environment.
So is the structure of this whole thing just taking the volatility out in this sense? The Fed, regardless of whether it's low or it's high, it's not moving anywhere, any place fast.
Yeah.
There's not a lot of delta in the whole thing. And they're really suppressing a lot of the volatility.
Yeah, remember, we have the Fed, which is, of course, the biggest of the central banks, but what the BOJ and ECB are doing shouldn't be underestimated as well. And even as the Fed takes back accommodation, it does so in a incredibly market-friendly, very, very telegraphed way. A concern I have is that the Fed's it's almost a third mandate, which is not just price stability vis-a-vis inflation, but also price stability in assets. And as they try to prevent a financial crisis, they live through this, the system being attacked by the assets themselves. They've created so much stability that traders are forced to lean on the stability. Alex, you pointed to the short vol trade. This has been the best Sharpe ratio trade that has been experienced by markets in a long, long time. You're talking about Sharpe ratios, so risk versus return, so north of what it means, or what you would realize just from being long the stock market. This is being able to generate return without ever, at least in the last 5 or 6 months, without ever really experiencing a down day.
John, do you want to buy vol here? You want to because it makes sense, but you can't because it doesn't make you money.
Well, I'm a very long-term guy. It's going to get volatile sometime. Something's going to happen. You know, the past is not the future. Things surprise us. I think what's happening, though, also is people are expecting something bad to happen. I mean, I remember once the mayor of Hoboken said, as we all know, Hoboken's the world's best-kept secret. Well, you know, when you know it, how could that be? And the answer is, I think a lot of people expect problems. So when something pops up, all right, we sort of thought that was coming.
So you have this low vol environment, then you have the NASDAQ hitting an intraday high, of course helped by the cyber attacks, right? You wind up having the S&P a stone's throw away from its record high. What's your base case? What sectors keep us grinding higher here?
Well, I think healthcare is one that we find very attractive, and part of it is my own experience, but you have an aging population, you have new technology, you have the government, I think, going to get more interventional in this one way or the other. Technology I'd like to buy, but I'm going to focus on the business-to-business stuff. Some of the other stuff's a little bit too high, but I think basically new things. And I think the economy is getting better, and as the economy gets better, I'm not sure I want to own every cyclical, but I think you start to move in that direction. I think that's where the incremental change comes.
Dean, I want to turn up the volume on something you said. Blame Vanguard for where the VIX is. What does it mean for price discovery full stop across the index and within it, of course? And when John starts talking about the fundamentals of a sector, should we be having these conversations anymore if the money's ultimately just going to flow into the index and get distributed across the sectors evenly? Right,
it's an open question, but a really important one, which is for the active manager who's paid to evaluate the fundamentals, decide when to get in or when to get out based on those fundamentals. When the flows into indexation, passive indexation, are so dominant, the price discovery vis-a-vis fundamentals actually gets gets compromised. I come back to central banks. The asset class for which there's the least price discovery is the sovereign bond market. You've got the gorilla in the room around the world has bought a lot of paper and continues to suppress volatility and suppress outcomes.